Hello, good evening. Good evening, everyone. Welcome to Market Analysis Live for Sunday, April 19th. This is George from TRADEPRO Academy. I want to welcome you to an exciting session. We've got a lot of updates of the markets. A lot of our trades are triggered this week, and we have to talk about those and give you a prompt update. Can you guys just confirm that you can hear me? You can see the screen. Just give me an OK, and we'll proceed with this. Just for those that are just joining, we do want to remind you of the disclaimer as well. The information contained in this presentation is for educational purposes only and should not be taken as investment advice. And at the end of the day, the trades that you place put you at risk, but also you can make the money as well. So just please do your own analysis. Use this as an educational resource and enjoy it for that purpose. Okay, so there you have it. The lawyers are happy. We can get started with Market Analysis Live. We got a really exciting week in the markets. A lot of things were taking place. It looked bullish temporarily, and then the markets took a massive hit on Friday on really strong volume. So we're going to talk about all that and a number of other things. Let's get started first and foremost today with the news, economic news of the past week. Some interesting things took place. I'm just going to flip here using the Forex calendar on forexfactory.com. All right, so here we go. On Monday, we had absolutely nothing. Tuesday, we had retail sales in the U.S., weaker than expected. The producer price index also weaker than expected. Retail sales month to month weaker. GDP in China pretty much 7% as expected. 7% is huge for the United States. For China, 7% is a recession versus the usual 13+%. All right, and then on Wednesday we had the European interest rate, which was going to be 0.05. There were absolutely no surprises here. That came out. We had a press conference as well. Mario Draghi was talking about the market and how it was impacted by the interest rates. And they're seeing some stagnation, so there's no growth even though interest rates are cut, which is really interesting. Wednesday as well at 10 a.m. we had the Bank of Canada rate statement, and the overnight rate, it was not changed. Kept at 0.75%, and it's been there since the 25 basis point drop a couple months ago. All right, and then through Thursday we got some unemployment claims weaker than expected. And weaker means here higher number because more people filed for unemployment claims than the expectation of 284. So 10,000 more. Actually, yeah, exactly 10,000 more people filed for unemployment claims, which means they recently lost their job. So not a good indication. All right, on Friday we had some CPI, which is a measurement of inflation release. That came pretty much on par with what was expected out there, 0.2%. And the University of Michigan Consumer Sentiment Study from the United States came out more positive. So there you go. Inflation is low. Actually, inflation's higher than projected with the core numbers here, 0.6%. Jobs are down. Retail sales are lower. And people are making less money. Less jobs are available out there in the marketplace. Yet, for some reason, consumer sentiment is higher. So go figure. Markets are an interesting machine. They get irrational sometimes. All right, what's coming up this week? Not much. That's the exciting part as a trader. Not much is coming up there to interfere with our trade plans and setups. More so news comes later during the week. But nothing really to stop us from pulling out our technical analysis and doing some good quality trades, good quality setups that allow us to profit. All right, so look at this. Monday, nothing in the U.S. Tuesday, nothing. Wednesday, nothing. Thursday, unemployment claims, as always, at 8:30 in the morning. And Friday, we have core durable goods orders. Not going to make that much of a difference. So it's a light week in news, and which means it's a fantastic week in trades. All right, let's have a look at the markets. Let's pull up our Trade Navigator here platform. I hope you guys are enjoying the options course so far. I know some of you are taking it. You can see the video usage. A lot of you are watching it. Some people must be rewatching it based on the amount of data that was going through on the server. But good job. If you have any questions, you guys know where to find us. And on the new website, there's also contact your TradePro Success Coach. You can use that link as well. All right, so let's kick off a few things that we've noticed in the markets this week. Here is Dow Jones, S&P 500, NASDAQ, and the Russell Index. As you can see, Dow Jones has been holding this ascending trend line here, or support line. And recently, it's also been making lower highs, which creates a resistance line. And it looks like a triangle-based pattern or chart pattern on the chart, and chart pattern on the chart. Genius statement, but there it is. That's what it's doing. It looked really good Monday through Wednesday. The markets were going up. Volume was even starting to increase. Then Friday, markets absolutely got pummeled on all fronts. Dow Jones down. Look at this. S&P 500 same deal. Nice bearish candle with volume increase. And that's really the interesting part, was not just that the price dropped, but it happened on an increase in volume. And as traders, we know that means that the sentiments have shifted from a bullish bias to flat out neutral to now, even with this volume coming in, to slightly even bearish, down to around 17,000 on the Dow Jones and potentially to 2031 on the S&P 500. NASDAQ is holding this range. It's right in the middle. So expectations for it to remain within this range in the upcoming week. The interesting index here is actually Russell. Look at this. The connecting highs and the connecting lows are creating rather a rising wedge pattern. And that's a particular interest to us because this rising wedge pattern here usually ends, if it's terminated, it's a terminal pattern, usually means that bearishness is to come and the stocks are expected to drop. Now the Russell is 2,000 of the smaller cap stocks in the United States. And small caps are seen as a leading indicator, which means if your small cap stocks are doing well, that means your market's probably healthy and doing well. Smaller companies are functioning, making profits, and the economy is in good health. Now, if the small caps are dropping, that's usually an indication that there's overall problems coming and looming in the dark. Last week we talked about this yield curve transition, and we said that the last time the yield curve started to flatten out that much and the rates were the same for a 5-year and 30-year bond, well, a lot of trouble came in the marketplace. It was 2009, and remember what happened then. Okay, now with the rising wedge and the small caps, this could also be a divergence indicator for the overall equity market. So very interesting stuff indeed when you start to layer this information in. All right, so that's the interesting part. There is a lot of doubt here in where the market's going to go. A lot of people saying there's going to be some bullishness. A lot of people say there's bearishness, and we're dead smack in the middle. We're confused as everyone else because we're in a consolidation pattern that could potentially break out to either direction. So we really have to keep an eye out here on our supports and resistances, chart out our analysis, and just be very patient, because patience is what pays in today's markets. 2014 we had a record year, and we said, hey, you know what, 2015 is going to be harder to make money as a trader. And unfortunately we were right. All right, and not often do I say that, but unfortunately we were right. It's tougher to make money in today's market because we're going sideways, and as traders, that's why we did the options course, because this is where we can take advantage of some neutral strategies here. So overall, Russell, rising wedge, potential bearishness. S&P 500 in a huge triangular potential rising wedge as well. Friday, massive bearish candle on S&P and the Dow on increasing volume. So the damage in the chart has been done. Interesting to see if this week will follow through. We'll continue lower at about 17,000 and 2031 on S&P 500. Okay, starting the week after next, we're going to, so let me give you a date. The week after next being May the 3rd, we're going to start trading all the option strategies, including iron condors, which are fantastic in this type of environment. So we're going to include those in our repertoire and a number of other things as well. So get through those options course videos. I know there's 4 left to do, but they'll be up and running in the coming days for you guys. I've recorded some of them. I just got to finish up the course. Okay, so overall markets at a pivot, potential downside to come based on volume analysis. Now, if you start to look at some of the interesting thing here, I'll show you. If you look at the subsectors or the sectors that make up the S&P 500 index and other indexes overall, or other indices, there's some interesting stuff going on, and I'm going to show you this interesting stuff based on, here we go, sector analysis tool using Trade Navigator. Look at this. In the last 6 weeks, which one do you think the best performing sector was? Well, guess what? Energy. Energy's done really well, all right? The oil recovery has benefited a lot of energy stocks, up 5%. The worst ones are transportation, technology, hardware, and equipment. But look at this. If you start to look at 18 weeks, all right, the worst one, transportation, retailing, has been up top overall for the last 18 weeks. Look at 26 weeks for the sectors. It starts to get interesting, right? Because at one point you're going to see for worst performing energy. Okay, it starts to join the worst performing group. So overall, in the long run, in about a year, the worst performing is 10% down, energy stocks, all right, and they're the only ones that have a negative return in the last fiscal year. But recently, they're the ones that have the momentum. So it's a rebound in energy in a bearish market, and never forget that. We're not trading a massive bullish rally here. What we're trading is a huge drop off in oil, and we're in this little phase here. All right, and we know this little phase rounds off based on fibs and could continue lower. So just never forget this. The placement of the trend that we're in is super important. So there's a little sector analysis for you guys. And I found it really interesting. I'm going to show you something here. I'm going to compare the different, actually what I'm going to do is open up the sector analysis right here. And I'm going to flip through, show you the bank stocks. We're going to just look at a few of the sectors and how they compare to the overall S&P 500. And you're going to start to make some weird encounters here, weird observations. Okay, so as you look at this, S&P 500 is the purple line, and each sector that I click on and I tell you about is actual candles. Okay, so banks, they're underperforming S&P 500 right now. It looks like a double top at the moment. That's an interesting occurrence. Look at energy. Okay, energy, although it's making a rebound in the last couple weeks, it's still phenomenally lower than before. If you look at July 2014, this is a huge fall off in those prices. Look at, for example, what else? Another one that's really good. Materials doing slightly worse than S&P 500. So what I'm trying to show you here is a lot of these sectors are actually telling us that we're actually bearish on this. Look, we hit a high, we're lower. Another one that's really good is retailing. All right, retail sales account for a large part of the U.S. economy. Look at this. Retail sales are peaking, huge bearish day, and they could signal here a triple top or a rising wedge. And if retail sales starts dropping based on the sector, then we're in trouble. Okay, if retail sales drop, guess what? Profitability for companies drop, and earnings drop, and a whole bunch of stuff starts to trickle down, and we could face another down cycle in the overall markets. All right, the other one that I wanted to show you is housing. Where's the housing one? There we go. Household and personal products. No, that's not the one. One moment here. Where was it? Where was it? See, real estate prices themselves as well in the United States. That's what I wanted to show you. The REA index that shows you the overall real estate prices. Look at this. They're lower. All right. So they're actually in an already retracement or downtrend from this massive rally. So 2015 overall, guys, has been a year where we're starting to find some bearishness and some downside taking place. Actually, here's real estate right here. There we go. Now it just loaded. It's headed downwards. So interesting things taking place. A lot of the subsectors are diverging, or the sectors are diverging from the overall index, which could signal some downside. All right. Another one of the things that we studied in the TRADEPRO Foundations course, that you guys might remember, was the idea of the Dow Jones versus the transportation average. Right. So we said one of the core tenets of the Dow theory, tenet 5, was that averages must confirm each other. And that means that when the Dow Jones is increasing, the transportation average should also be increasing. Should the transportation average cross below, this bearish cross tells you that we could be in for a correction or 10% plus drop in the market. So curiously enough, I pulled it up this week, and here's what we got. So if you click on compare dollar DJ TA, and look at this. The Dow Jones transportation average has broken below the industrial average, and it's actually doing lower lows, okay, lower highs. Looks like it's a bearish trend, and it's broken below this previous bottom. All right, look at this. It's right at it. It's broken below, and volume is coming in for bearishness. So if this is anything to give us an indication, Dow Jones is also going to head lower. Right? Remember, this is one of the core tenets of the Dow theory that's been put to work, and it's very powerful. Look at this. Last time that happened, just to give you an idea, last time it diverged, shortly after the market went for a massive, in 2013, sideways trend. Okay, so that's interesting stuff that we follow. So could that happen? Who knows? But I want to show you back in 2011 as well, and there was a recession. The Dow Jones Transportation Average here is the purple. It started dropping first, and then the industrial average was still crawling up. And this divergence here that was taking place, look how it ended. Well, on a massive drop. So whenever these two diverge, that's a really, really strong indicator for us. Okay, so any questions on divergence so far? A comparison between the transportation and the industrial average that we've looked at. Because we're going to do another divergence that I've just noticed take place in markets here. This is between the Russell index. Remember what we said, the Russell is small cap, and the S&P 500. And I'm going to show you that comparison right now. Where's our Russell indicator? Let me just zoom in. There we go. All right, we're going to compare S&P 500. So SPX is, again, the purple line here. You'll notice some interesting things in 2014. Let me just zoom out a little bit, show more data on the chart.